Joining me, Dan Clifton is Strategas Research Partners Head of Policy, and Dave Zervos is Jefferies Chief Market Strategist, a CNBC contributor. Not Fed Chair, Dave, unless you have anything you want to, tell us about your conversations over the weekend.
I've got no comment on that.
Yeah, I understand.
We can talk about all the other stuff.
I understand. It is truly great to see you guys, and I appreciate you being here today. Do you, I know, Dave, you've been pounding the table about this for a long time. The fact that low yields themselves are a really important development, but I don't know. Today, obviously, a little bit of a different story because there was some dovish talk out of the Bank of Japan, and suddenly everyone's, on a yield strike. What do you think is going on here?
I think your chart was a very important one that you put up in the beginning, Kelly, that, it's a nice perspective to be out for a while and come back. We've had an incredible run lower in yields. When I was first talking to clients in the beginning of this year, people were telling me, oh, we're going to 5, we're going to 5.5. We might go to 6 and 10-year yields. And here we are at 4, down from almost 5. So I don't think a lot of people have this trade. We pushed pretty hard on the idea that neutral is going back to its original state of pre-COVID, which is a very non-consensus view, and I think will continue to be one. But I'm going to keep pushing on it. It's coming my way. Got a little more to go. But I think it's interesting from my conversations with clients. I've seen more converts, meaning people here at these yield lows toward 4% are actually much more open to the idea that yields are going to head quite a bit lower before all is said and done. So it's interesting. Maybe that's a bad sign because you always want to be against the grain, but right. I think people are more open to the lower rate narrative now than they were.
The only other person who was out there talking about this, how the deficit might actually start getting better. You know where I'm going, Dan Clifton. It is playing out a little bit. I mean, on some level, I wonder if that's why crypto is crashing. You're taking away the narrative of, dollar implosion and fiscal deficits to the moon and economic, problems. And I don't know, crypto's probably suffering under its own collapse and leverage. But do you know what I mean? Like, there's something here where you go, hey, the broader economy is looking okay at this point.
Well, first, Kelly, welcome back. It's great to see you, and thank you for having me on.
Thank you.
As you know, at the beginning of the year, we were talking about rates going to 4% when they were at 4.8. Some of that was temporary. It was the liquidity boom that we were going to get from the debt ceiling, but it was also those other factors that you mentioned, the deficit improving, as well as being able to use the liquidity tools that are available to the Treasury. And the Treasury continues to use those tools, and I think that they will continue to do so. And then you got financial deregulation, which is coming up in early February, early 2026, probably in February when you see it, changing the GSIB rules and trying to unlock that capital on bank balance sheets and being able to use that to get mortgage rates lower and bond yields lower. So there's a lot there. But I would just urge some caution here. There's some plumbing issues that are starting to develop. November was supposed to be a relatively easy month, and what you started to see was rates really creeping up higher at the end of the month, something that you expect at the end of the month, but a little bit higher than anticipated. And December is going to be a really tough month. You have corporate tax payments coming in, which are going to destroy bank reserves. You also have Treasury settlements of about $200 billion. You got the end of the year settlements for the banks. So this is why the Fed is getting rid of QT. That only gets them partial. We think the Fed is going to have to expand its balance sheet in the month of December to be able to make sure that there's not too much destruction of the bank reserves. So there's a lot going on, and they have to be very careful because you could start to see at least the overnight rates starting to go up and creeping on rates if the Fed is not proactive enough in dealing with this December liquidity crunch that's ahead of us.
Dave Zervos, you were just kind of talking again about this today, this idea that if we got the balance sheet back to 20% of GDP and we were heading in that direction, that's a pretty good sign for normalization. So what happens now?
Yeah, Kelly, I think it is a neutral balance sheet, as neutral was defined before COVID, when we were kind of in that happy place of a 20% of GDP Fed balance sheet, a 2% interest rate structure, largely across the curve, 2s to 10s. And, I think that balance sheet neutrality sort of begs the question of why are rates 200 basis points higher today than they were pre-COVID in 2019, when the unemployment rate was at 3.5% or lower, and today it's almost 4.5%. Why are you not working to satisfy your dual mandate of maximum employment and price stability when inflation expectations are largely contained? You've had a massive disinflation. You got a little bit of stubbornness, maybe the last 50 bips, but I don't know. I think this Fed has shown a little bit of a political bias. I've mentioned that a number of times on the show. to you before you left for a little while, and I've mentioned it while you were away. I think that's only increased, and I think it's a bit sad. I think it's a sad state of affairs that we're holding back this economy with rates that are 200 basis points probably above what we estimate neutral to be. And the Fed's done a pretty bad job of also understanding the evolution of neutral in the context of what the balance sheet was doing to neutral while it was large. And that's been a fight I've been fighting for a while.